Hello everybody, and welcome to the first quarter market review for 2021, where I will review quarterly performance for U.S. and international equities. I'll dig into various asset class performance, including commercial real estate and fixed income, and I'll also review how various diversified portfolios perform. Once again, I'm Sergio Mariaca, and just like all my other videos, I try to break down some of the key principles around investing in a way that is understandable so that hopefully you can be a more informed and disciplined investor. Now, before I get started, I'm going to be reviewing historical performance, and I need you to know that past performance is never a guarantee of future results. Next, everyone's situation is different, and this information is for general purposes only. It does not constitute investment advice or a recommendation of any kind. So as vaccinations continue to accelerate, providing a much needed shot in the arm for our country and our economy, I am hopeful that you are also feeling more optimistic about this year and our future. As of the end of March, approximately 32% of the total U.S. and 75% of adults over 65 have received at least one dose of the vaccine, and 20% of the U.S. are now fully vaccinated, including yours truly. We are now hitting over 3 million doses being administered each day in the United States, and as this pace of vaccinations continue, the prevailing expectation is that we will experience a significant pickup in domestic and global economic activity, which we are already starting to see. For example, in March, U.S. employers added a whopping 916,000 jobs, blowing past the consensus estimate by almost 300,000 jobs, which is pretty incredible. And stock markets enjoyed another positive quarter this past quarter, the fourth in a row since last year's March pullback, with the S&P closing on March 31st just a few points shy of 4,000, which it hit on April 1st for the first time ever, no joke. And this is all very welcome news for those businesses and their workers who have been disproportionately affected, like restaurants, gyms, certain retail businesses, and of course the travel industry. Hopefully, all of this good news should allow those industries, those companies, and those workers to finally reemerge in the coming weeks and months, which is just great news. Okay, let's go ahead and get started. So as we get started, let me remind everybody that I am going to be writing on a glass surface, and so that tapping sound isn't something wrong with your speakers. I'm also going to use green for positive performance and red for negative performance. All right, let's go ahead and start by looking at first quarter 2021. And to provide some historical context, let's see where we were at the end of the first quarter in 2020. U.S. stock market was down 21% first quarter last year. International was down 23, developed, international emerging also down 23, and then leading the way down was global real estate because everybody is working from home and we did not know what the future was going to look like. So in this chart, we have first quarter performance over here. Everything is nice and positive across the equity spectrum, including global real estate. And then fixed income is negative. And it is not surprising or unusual to see bonds underperform or lose value when stocks are doing well. Because generally higher quality bonds move in the opposite direction of equities. They are negatively correlated in general, not always. Now, what is interesting to me is as bad as this quarter was a year ago, and I'm talking about the first quarter 2020, we only had one brand new record for the worst quarter on record, and this is data going back to 2001. All the other first place positions for worst possible quarter since 2001 happened at the beginning of the Great Recession in 2008. Another interesting thing I want to point out is, generally speaking, worst performing quarters precede the best performing quarter. So in 2008, we had the worst performing quarter for global real estate. Same thing for emerging markets, followed by the best quarter a few quarters later in 2009. And that's what we saw across the board. But last year we had a brand new worst quarter for this guy over here. And then we also set a best quarter record for U.S. equities in the second quarter of 2020. All right, the other thing that jumps out at me is we set a brand new record for the worst quarter for U.S. bonds. Not surprising. I mean, if the worst quarter, you're down 3.3% when other asset classes are down much worse in their worst quarter, not the biggest deal in the world. And then last thing I'll point out is that these were pretty good quarters when we compare it with the average quarterly return. So in every situation other than this guy, it outperformed the average quarterly return that we have seen since 2001. So pretty good quarter. And that follows three other positive quarters. So this is the fourth positive quarter for equities, international and domestic. All right, so now we're going to look at 1 year. This is speculation, and then we've got 5 and 10-year averages for these asset classes, and I call this the investment zone. Okay, anything over 5 years is investing, 1 year is speculating. All right, and to provide some historical context again, first quarter 2020, where were we for that 1 year average? Well, U.S. equities for the previous 1 year was down 9%, international developed down 14%, international emerging was down about 17%, and then once again leading the way, global real estate down 23. And what's interesting is I bet you there was a lot of people at the end of the first quarter 2020, they were scared to death, and rightly so. I mean, who could blame them? And they probably abandoned their risk assets, and that's why the market pulled back dramatically as people were selling, and they missed out on that second quarter, which was the record for U.S. equities, and this incredible following 12-month performance for U.S. international and even global real estate. Here is the most important data point, and that is for U.S. equities. Over the last 10 years, U.S. equities have averaged almost 14%, and we have 94 years of data where that number is closer to 11%. So 14 is about a 25% premium over 11, and that is huge. Part of the reason I believe U.S. equities and equities in general are doing so well over the last 10 years is because fixed income has done so poorly. When your bond performance is barely outperforming historical inflation, you are going to see a lot of those stable, safe assets find their way into risky assets, chasing performance. I would suggest that is not for everyone. It can be extremely destructive. All right, let's go ahead and look at the mountain graph. We notice right over here at the very beginning of April, we still had some down to go. The market was still pulling back. But then sometime in the very beginning of April, the recovery started. And so in that first quarter, we added 22% to the Russell 3000 that's the second quarter, but the first recovery quarter. The second recovery quarter, which was the third quarter for 2020, we added another, I believe it was 9%. And then in the fourth quarter of last year, the third recovery quarter, we added another 14. And then this last quarter, first quarter of 2021, we added another 6. Let me just suggest to you that all these stories here are probably just noise. They're a distraction potentially from your long-term evidence-based plan, and you need to figure out how to tune some of those out, because some of this is really negative news, some of it is extremely positive, but probably doesn't have a big impact on trying to predict the future performance. All right, looking at select market performance, I like to just take a look and see what is performing the best and where it was last quarter. So even though, and we're talking about the Russell 3000, a broad benchmark for the U.S. economy, was up 6% in the first quarter. Look at the S&P 500. A year ago, that even though the market was down, the S&P 500 was down less. It outperformed everything else. It was the best performer in the second quarter. And we certainly probably had a lot of investors who said, listen, I'm going to stick with just the large cap companies, maybe even focus on large cap and technology companies, because they did really, really well last year, especially up until the beginning of September. And by doing so, you would have missed out on small cap value. The Russell 2000 is a small cap index for domestic stocks. Value is the style, so value is opposite from growth. And so last quarter, fourth quarter 20, that was in the number 1 position, and small cap in general was number 2. And that's why you want to be diversified. And then when you have equities doing as well as they've done this last quarter, again, not surprising to see bonds underperform. Let's go ahead and look at international developed and emerging markets. What I like to point out here is here's the U.S., okay? We've got 9 developed countries that outperformed the U.S. In the first quarter. And then everything above this line also outperformed. So there's another 17. So that's 16 developed and emerging markets that at least in the first quarter outperformed the U.S. The lesson there is have some global exposure, because not all return is U.S. based. All right. One other thing, which I think is pretty interesting, not always the case, but last time around, the best performer was Colombia. Now it's the worst performer. We don't always see that, but it's not unusual to see the best performer become the worst and the worst become the best. Not every quarter does it switch like that, but from quarter to quarter, year to year, we can see that trend. All right, moving on. Let's look at U.S. stocks, and I think there's some important information here. First of all, at the end of the first quarter, the U.S. accounted for 57% of global equity. Those are publicly traded companies. For the second quarter in a row, small value is number 1 and small cap is number 2. We're seeing that rotation that we've talked about. Large growth underperformed the rest of the market. That was the best place to be in most of 2020, and at least this quarter, worst place to be. So if we look over 10-year performance, the best place to be over the last 10 years was large cap growth. Worst place to be was small value. Look at the performance over the last year. Large cap growth, 62%, nice. Look at the small value. So I imagine there are those investors that totally abandon small cap exposure and value tilts because for the last several years at least, large cap has outperformed small cap at least over the last 10 years. And for many of the last few years, value has outperformed growth. You always want to have exposure to different assets, different asset classes, different asset sizes, small cap, mid cap, large cap, and style tilts. And then when something's down, buy a little bit more because it would not be unusual for it to outperform. So if we look at the last 3, 5, and 10 years, best place to be, large cap growth. But year to date and over the last year, best place to be is small cap and small value. The interesting thing is over 10-year rolling periods, 72% of the time, small cap outperforms large cap. So it would not surprise me if over the next couple of years, small cap continues to outperform. And at some point in the future, we'll look back over 10 years and we'll see small cap outperforming large cap. And then value versus growth, 82% of 10-year periods, value outperforms growth in domestic equities. So you want to make sure that you don't abandon value if it's underperforming as it has over the last couple of years. All right, let's look into international equities. At the end of the first quarter, accounted for about 30% of the global market cap. We'll just look at U.S. currency. Not surprisingly, small cap and value are at the top. Best performing, again, second quarter in a row that those repeat in those same number 1 and number 2 positions. If we look over the last 10 years, best place to be is, again, growth. Worst place to be, value. And if we look at the statistics, 88% of 10-year periods, small beats large, right? And so over the last 10 years, large is outperforming small cap. So wouldn't be surprising to see that flip because that's a pretty reliable indicator that small cap outperforms large cap in international developed over longer periods of time. And then 98% of the time, and that's a very strong indicator, value outperforms growth. All right. And so again, year to date, we're starting to see that reemergence, but over 10 years, growth is still trouncing value. So it wouldn't be surprising if we look at this in a couple of years and we see that relationship normalize along those historical trends. Emerging markets at the end of the first quarter, emerging markets accounted for 13% of the global exposure. Year to date, small caps up 7%, values up 4.11%. And these two switch places. So value outperformed in the first quarter. Small cap was in second place. Over the last 10 years, best place to be, once again, just like international developed and U.S. equities, growth was the best place to be. And small cap just slightly underperforms large cap, and 92% of the time, small outpaces large cap over 10-year periods, and then 82% of the time, value outperforms growth. So again, wouldn't be surprising to see some of those historical trends reestablish themselves in the coming years. So stay diversified. And then real estate at the end of the first quarter, 62% of publicly traded REITs were based out of the United States. The balance, 38%, were outside of the United States. Last quarter, so fourth quarter 2020, global was in first position and real estate in number 2. But over the last 10 years, U.S. real estate continues to dominate. And I think they dominate across the board, and that is not unusual. Let's go ahead and look at some of the more stable and safer assets. So we're talking about fixed income. And so when U.S. equities are doing as well as they have been, not unusual to see bonds negative, especially longer-term bonds are going to be more sensitive to interest rate risk, and they'll lose even more value. It's also not surprising to see the equity surrogate, high-yield bonds, we talk about this all the time, being the best performer for the quarter. And look at that return over the last 12 months. I mean, that looks like an equity return. In fact, over the last 3 years, almost 7%, 5 years, 8% a year. And over the last 10 years, you would nearly have doubled your money with high yield bonds. I just want to remind you that the first quarter of 2020, high yield was down 12.68%. So while high yield does very well when the market's doing well, it is not a good, stable, secure place for your assets when your stocks are down. Your high yield is going to be down as well. You're not going to have the ability to rebalance effectively. And so just be sure when you are chasing yield, you are not going into assets that have a higher risk profile than you really believe that they do. All right, last slide is the impact of diversification. Again, we would expect that as you add stock exposure, so this one up here is 100% stocks, when the market's doing well, that's going to be the best performing quarterly portfolio, 100% in stocks. And we measure risk by the standard deviation. So the higher that value is, it means that position, that portfolio has more volatility, more risk. So as we add on risk, so 100% in T-bills, safest place to be. You barely made 1/5% over the last, you just made about 0.5% over the last 10 years. But look at that risk value, very, very low. And 100% stocks, much, much higher. So over 10 years, as we add risk to your portfolio, your performance goes up. Over 5 years, we see the same relationship, which we expect to see over longer periods of time. It holds up over 3 years, and it even holds up over 1 year and shorter periods. This is where it can break down. Mostly, you're going to see it over shorter periods, but over longer periods, it tends to hold. As you add risk, you should see return as long as your risk is diversified, high quality, etc. All right, my friends, that's the first quarter. In closing, thank you for your time and attention. I hope you learned something. So while equity markets have enjoyed their fourth positive quarter in a row and we are all feeling more optimistic, it is still vitally important to understand and follow the investing principles that stand the test of time, because there can always be a crisis of the day or some other distraction in every kind of economic environment that can confuse and disorient us from our long-term strategy. Of course, I'm referring to this quarter's Reddit rally around GameStop and the mania surrounding cryptocurrencies, among others. It is also critically important to understand the difference between investing, speculating, and frankly, gambling. And one important best practice is to not take investing advice from social media. As I repeat after each quarterly review, we live in a very noisy world, so look past the headlines and the social media posts and do your best to control your emotions so that you can stay disciplined when it really counts through any market dips and swings we may experience. Focus on the long-term drivers of return and let markets work for you in an appropriately diversified portfolio for your needs and risk tolerance, including staying away from the hyped up stocks of the day. Now, please follow and like us on social media where we post these kinds of videos and other content, and go out there, get vaccinated, enjoy a great rest of the spring, and have a super summer. We will see you soon.